Morning everyone, welcome to Ainsley News. It's Monday, the 16th of May. We're talking Aussie property today at the Precipice. It's hard to pick up a paper and or read the news without headlines around plummeting auction clearance rates, stalled house sales, predictions of big house price falls, and then late last week we got the ABS stats showing new home and construction finance commitments literally halved from HomeBuilder stimulus February 2021 peak, and likewise dwelling approvals down 36% year on year. Big numbers there. The combination of removed stimulus and rising rates is weighing heavily, and hence no end of promises from both sides of our political parties of rescue packages in the lead up to the election. Indeed, if one were to believe the future markets, Aussie rates are rising right up to 2.8% by the end of the year and peaking at 3.5% by mid-year. Off our near zero base, that equates to an incredible 10 by 0.25 hikes in just 7 months to year's end, and another 3 hikes to July 2023, the most aggressive hiking period since 1989. This last week from Bloomberg, they noted one of the world's most expensive property markets faces its biggest test in more than 30 years. Australia's $10 trillion or $7 trillion US residential real estate sector will this year have to absorb the sharpest interest rate increases since 1989, if bond markets are right. The Reserve Bank last week began its first tightening cycle in 11 and a half years, shaking the confidence of consumers with some of the world's highest debt loads. Based on market pricing, Sydney and Melbourne could fall by up to 20%, said Diana Marcina, a senior economist at AMP Capital Markets. There's a potential for steep falls in these markets because the run-up in prices was larger and households in these cities are more under leverage constraints. But Messina, like most economists, says the central bank can't afford to be that aggressive. The last time rate hikes of that speed and magnitude occurred, it almost triggered a collapse in the financial system. She's not alone. UBS also said, we expect the RBA hiking cycle to get stopped out earlier than most and far below market pricing, as we think the latter would likely crash the housing market and cause a recession. And so we have the same dynamic playing out in our housing market as the US has in its share market. Just how far and brave will the central banks go? Tarek Brooker looked back at Australia's records and found the most aggressive rate rise cycle ever was 2002 to 2008, which saw a 58.5% rise ending with the GFC crash. For context, the rises priced in by futures markets currently sit at over 120% increase on current rates. However, the big banks are not buying that, or at least are hoping for markets as they're wrong, and forecasting as follows. The CBA, cash rate to peak at 1.6%. Westpac, cash rate at 2.25%. NAB, 2.6%. ANZ, 3%. The futures market, cash rate to peak at 3.56%. To put that into perspective against the 2002-2008 previous all-time record, I've got a chart here that you guys can check out via ainsleyboyne.com.au. Just click on news and you can click on and see all of today's charts. We separate out Westpac, NAB, CommBank, ANZ market pricing and the rate rise cycle comparison there for you. And so only the CBA are calling for less than the record, and ANZ nearly as bad as the futures markets. This also from Brooker. In short, Australians have never seen interest repayments and their mortgages rise so much in a single rate rise, making this a truly unprecedented event should any of the big bank scenarios come to pass, with the exception of that of CBA. There is no doubt that the late 1980s and 90s presented a highly challenging environment for mortgage holders. Many of us grew up on the tales of necessity of sacrifice during that time from our parents. But purely based on the magnitude interest repayments are precedented to increase, the potential upcoming challenge for existing mortgage holders is something else entirely. This is not just an Aussie problem. Societe Generale's global strategist Albert Edwards believes we have a global problem in property, while all eyes are on equities. I think GMO's Jeremy Grantham is right. Yahoo News reports that Grantham believes we're in the midst of the 5th greatest bubble of the modern era, following the Wall Street crash of 1929, the Japanese asset bubble of 1989, the dot-com blow-up of 2000, and the global financial crisis of 2008. But Grantham argues the US economy can likely weather dramatic drops in the stock market, as evidenced by the mild recession when tech stocks blew up during the dot-com bubble. But when it comes to a housing crisis, he says, the economy is unlikely to come through unscathed. The dot-com bubble of 2000 showed you can just about skate through a stock market event, But Japan in 2008 showed you can't skate through a housing crisis. Maybe the day of reckoning for the US housing market has arrived. Record house price inflation of around 20% year on year has just been smacked by soaring interest rates. 30-year fixed mortgages rising from 3% at the start of the year to above 5.25% now, their highest level since 2009. But the residential property bubble is a truly global event, and the US isn't the worst offender. UBS calculates the bubbles are far worse elsewhere, with, somewhat incredibly, Frankfurt being the biggest bubble of all, followed by the usual suspects. Having created an everything bubble, we know from 2008 what path we're headed down. Yeah, sure, it's different this time. It's definitely worse. As you can see from another chart we include in today's news, Australia still sits at one of the most overvalued property markets in the world, and how this ends is simply unknown. Like the Fed, the RBA is stuck between a rock of rising inflation and the hard place of raising the cost of servicing an unprecedented debt pile and causing a very hard recession. And that's news for today. Thanks for joining us. Jump over to anzbullion.com.au, click on the news if you want to check out any charts, but you can also purchase gold, silver and platinum from our website. ainsleywealth.com.au for all things crypto. That's bounced back quick over the weekend, as everybody's probably seen. You can also, if you've got to buy the dip, well, congrats. If you're looking to buy on this rise right now, jump over to ainsleywealth.com.au and purchase there. And goldsilverstandard.com, which is our own crypto built and backed by real gold and silver. Enjoy your Monday, everyone. We'll catch you tomorrow for more news.